Hello students, now we'll resume our classes. So previous session we have completed problem number 7 and now we will start problem number 8. See here, an investor owns units in 4 different mutual funds A, B, C and D. So 4 mutual funds. Hope you have taken the copy from the link given below. In description you will find the link of Google Drive. Go to that link and get a printout copy. So before watching the video you must have a printout of these problems. Now he wants to dispose of the units in any one of these funds. Under Sharpe's measure and Trainer's measure, which mutual fund should he dispose of? Mutual funds are given A, B, C, D. 4 mutual funds है. Standard deviation 8, 2, 10, 6, beta 0.5, 1.25, 2.1 and 0.9. Risk-free rate 5%. Return on fund 15%, 12%, 8%, 10%. So we have to apply Sharpe's and Trainer's measure and find out which fund he should dispose of. तो जिसका भी इंडेक्स सब में कम रहेगा वो फंड को डिस्पोज ऑफ करेंगे. तो वी कैलकुलेट द शार्प्स मेजर. Sharpe's performance index. तो SP is equal to RP minus RF divided by standard deviation of P. Now put mutual fund A. Mutual fund A. SP is equal to, what is the return on mutual fund? It is 15%. Minus risk-free rate 5% divided by standard deviation is 8. Mutual fund B. So return is 12% minus 5% divided by standard deviation is 2. Mutual fund C. The return is 8% minus 5 divided by 10. Mutual fund D. SP is equal to, return is 10% minus 5% divided by 6 is equal to. This is all about Sharpe's index. Now we'll apply Trainer's. Trainer's performance index. The formula TP is equal to RP minus RF divided by beta P. Denominator will change. The numerator reward will remain same. Here total risk, here only market risk. Mutual fund A. 15 minus 5 divided by beta is 0.5. Mutual fund B. 12 minus 5 divided by beta is 1.25. Mutual fund C. C, it is 8 minus 5 divided by 2.1. Mutual fund D. TP is equal to 10 minus 5 divided by 0.9. Now we'll calculate the values. 8 minus 5 divided by 1.25. Here it is 1.25. 12 minus 5 divided by 2. That is 3.5. 8 minus 5 divided by 10. It is 0.3. Then 10 minus 5 divided by 6.833. Similarly for TP it is 20. 5.6. 1.43. And lastly it is 5.56. Now he wants to dispose of any of the one fund, either A, B, C, D. Whichever fund has the lowest performance index, that fund will be disposed. So 1.25, 3.5, 0.3, 0.833. What is the lowest one? 0.3. Here 20, 5.6, 1.43, 5.56. Lowest is 1.43. We have selected the lowest index as per the Sharpe and as per the trainers. Now conclusion. You should write the conclusion. It is suggested to dispose of the mutual fund C. It is suggested to dispose of the mutual fund C, since for this mutual fund the index as per Sharpe as well as trainer is the lowest. Since the performance index of this mutual fund is the lowest as per the Sharpe as well as per the trainers. That's it. This is problem number 8. Now we'll start problem number 9. See the problem number 9. Find the Sharpe and trainers ratio using the information below. Again Sharpe. Also rank each fund in descending order according to each ratio. Risk-free rate is 4%. So A, B, C, D. Again 4 funds are given. Exactly similar to the previous problem. Sharpe's index SP is equal to RP minus RF divided by standard deviation P. Fund A. Fund A SP is equal to, what is the return? 16%. Risk-free rate 4%. Standard deviation 8. Fund B. SP is equal to 12 minus 4 divided by 6. Fund C. SP is equal to 18 minus 4 divided by 10. Fund D. SP is equal to 20 minus 4 divided by 11. Trainers index. TP is equal to RP minus RF divided by beta P. So fund A. TP is equal to 16 minus 4 divided by beta is 0.7. Fund B. TP is equal to 12 minus 4 divided by beta is 1.30. Fund C. TP is equal to 18 minus 4 divided by 1.25. Fund D. TP is equal to 20 minus 4 divided by 0.9. That's it. So these are the calculations for all the indexes. Now ranking of funds. Fund. Fund, then here we'll take Sharpe. Here we'll take trainer. Index rank. Index rank. A, B, C, D. That's all. So first of all, we'll make the calculations for the index. 16 minus 4. 16 minus 4 divided by 8. 1.5. 12 minus 4 divided by 6, it is 1.33. 18 minus 4 divided by 10, 1.4. 20 minus 4 divided by 11, 1.45. Similarly, 16 minus 4 divided by 0.7, 17.14. 12 minus 4 divided by 1.3, 6.15. 18 minus 4 divided by 1.25, 11.2. 20 minus 4 divided by 0.9, 17.78. That's all. So we have made the calculations of all the indexes. What is the first we write down. A index is 1.5, 1.33, 1.40 and 1.45. Here also 17.14, 6.15, 11.2, 17.78. So we have taken all the indexes according to Sharpe and Trainer. Now we have to give the ranking. What is the highest index of Sharpe? It is 1.45. So first rank. Below 1.45 is 1.40, second rank. Highest is, 1.5 is the highest. 1.5 is the highest, first rank. 1.45 second rank. 1.40 third rank and 1.33 fourth rank. 1, 2, 3, 4. Highest is 1.5. Next is 1.45. Next 1.40, 1.33. Similarly for index, trainers indexes, the highest is 17.78, first rank. 17.14, second rank. 11.2, third rank. And 6.15, fourth rank. That's it. So it is asking you to arrange the funds in order of ranking. So this is problem number 9. Now we'll see the problem number 10. 10th problem. An investor holds units in 3 mutual funds X, Y and Z. The risk-free rate of return is 9%. Find the missing figures in the table. Fund X, Y, Z. So Sharpe's measure, index, standard deviation, return on fund. Arrange the funds in descending order of Sharpe's measure. So first of all, missing figure we have to find out for the 3 funds according to Sharpe's. 10th problem. Finding the missing figures. This is the problem. Now first we'll take fund X. Sharpe's measure. Sharpe's measure SP is equal to RP minus RF divided by standard deviation P. This is the formula for Sharpe. Now we'll take fund X. Fund X, SP is equal to RP minus RF divided by standard deviation P. Now fund X, Sharpe's measure we don't know. But return on fund is 71 minus risk-free rate. The risk-free rate is 9%. And standard deviation is 41.30. So SP is equal to first fund completed. First fund X completed. Now fund Y. Fund Y, SP is equal to RP minus RF divided by standard deviation P. Now what is it is asking? In Sharpe's measure is given 0.43. SP is given 0.43. RP is given 17%, risk-free rate is 9%, but standard deviation question mark. So we have to find out standard deviation. 0.43 is equal to 17 minus 9 is 8. cross multiply 0.43 sigma p is equal to 8. So sigma p is equal to 8 divided by 0.43. Second point we got. Second fund. Now fund Z. For fund Z, SP is equal to RP minus RF divided by sigma P. It is Sharpe's measure is given 0.54. Return on the security not given. RP we have to find out. Risk-free rate 9% and standard deviation is given 13%. Now we can make the cross multiplication here itself. RP minus 9 is equal to 0.54 into 13. RP minus 9, 13 into 0.54. 7.02. RP is equal to 7.02. This minus will become plus 9. So RP is equal to 16.02. Here 71 minus 9 divided by 41.3. It comes to 1.50. And here 8 divided by 0.43. 18.60. Sigma p we got. Now we have found out the missing figures. The missing figures are the Sharpe's measure is not given for fund X. We have calculated Sharpe measure. For fund Y, standard deviation risk is not given. We have calculated the standard deviation. Third fund, return on the portfolio is not given. We have calculated the return on the portfolio 16.02. Now it is asking you to arrange the funds in descending order of Sharpe's measure. Arrange the funds. In descending order of Sharpe's measure. Descending order of Sharpe's measure. So first of all, what is the Sharpe's measure for X? 1.5. For Y it is 0.43 and for Z it is 0.54. So what is the highest value? 0.54, 0.43, 1.5. So highest is 1.5. Then second is 0.54 and third one is 0.43. It is asking you to arrange the funds in descending order. Index 1.50, 0.54, 0.43. Now we have to write down the funds. 1.5 is for fund X. 0.54 is for fund Z. And this is Y. So arranging the funds in the descending order of their index. The highest index 1.5 for fund X. And Z it is 0.54. SP of Z is 0.54. And SP of Y is 0.43. 1, 2, 3. That's all. This is problem number 10. Now, see the problem number 11. The following portfolio details of funds are available. The following stock A, B, C, D. Now, see carefully. The following portfolio details of a fund are available. Stock A, B, C, D. Shares are 2 lakh shares, 3 lakh shares, 4 lakh, 5 lakh, 6 lakh. These are the number of shares of each stock. Price is given, market price 35, 40, 20, 25. The fund has accrued management fees with the portfolio manager totaling rupees 30,000. There are 40 lakh shares outstanding. What is the NAV of the fund? Net asset value. Previous theory session I told you NAV is a very important concept from mutual funds point of view. Every mutual funds, the trade, this buying and selling of units is based on NAV. So how to calculate NAV? A major part of mutual fund will be invested in securities. The market value of securities will increase or decrease every day. So what mutual fund will do is they will calculate what is the present value of their investment. They multiply the market value of shares of securities with the number of shares. They will get the value of all the securities, investments, assets. From the value of the assets, subtract the liabilities and divided by number of units of mutual fund. We'll get the NAV. On the basis of that NAV only, the units are traded. Now in this problem, we have to calculate the NAV. Calculation of market value of shares. Stock, number of shares, price, then market value. Shares stock are A, B, C, D. Number of shares are 2 lakh, 3 lakh, 4 lakh and 6 lakh. Price 35, 40, 20, 25. This is the information given in the problem. Now we multiply 2 lakh into 35. 2 lakh into 35 is 70 lakhs. Similarly, 3 lakh into 40 is 1 crore 20 lakh. Then 4 lakh into 20 is 80 lakhs. Last one, 6 lakh into 25, 1 crore 50 lakh. Now we add up all the market value, we'll get 4 crore 20 lakh. This is the total market value of all the investments in 4 stocks, A, B, C, D. Now NAV of the fund. Is equal to total market value minus outstanding liabilities are given now. The fund has accrued management fees. Outstanding management fees. This is a liability. Divided by number of units outstanding. So market value of all the investments 4 crore 20 lakhs minus outstanding liability is 30,000 divided by number of units outstanding is given in the problem. 40 lakh shares are outstanding. यूनिट्स कहिए या शेयर्स कहिए, मीनिंग सेम. तो 4 crore 20 lakh minus 30,000. 4 crore 19 lakh 70,000. 4 crore 19 lakh 70,000 divided by 40 lakh. 10.49. The NAV of the fund is for 10.49. 4925. So this is the first problem on which we have calculated the NAV, net asset value. So by doing this problem, the concept is clear that NAV is nothing but the value of 1 unit of the fund. So how to calculate the value of 1 unit of the fund? Take the total market value of all the securities, investments. From that, deduct the liabilities and divide it by total number of shares or total number of units of the fund. That's it. Now we'll start the next problem, that is problem number 12. 12th problem. The following table gives the return. The following table gives the returns over the past 6 years of Rose Fund market returns and risk-free returns. So year 2008, 9, 10, 11, 12, 13. So totally 6 years returns are given: return on Rose Fund, market returns and risk-free returns. Determine the Jensen's measure of Rose Fund and state whether it had performed better than the market. It's a very important problem. Now Jensen's measure. For applying Jensen's measure, we need RP, return on the portfolio. So return on Rose Fund is given for 6 years. We calculate the average return of Rose Fund, that is RP. RF, risk-free rate. Risk-free rate are also given for all the years. It is different. We calculate the average return, RF, we can get. So we can get RP, we can get RF. Then alpha we have to find out, and beta is not given. So we have to find out the beta also. How to calculate the beta? The returns are given for Rose Fund and the returns of market. By taking this reserve of the returns of the company and returns of the market, we can find out the beta coefficient. Beta coefficient. Then RM minus RF. RM market return. Take the average of the market return. Like this, we can be able to apply the Jensen's measure to evaluate whether this Rose Fund is performing better than the market or not. This is the problem, right? So first, we calculate the average return. Problem number 12. Average return of Rose Fund is equal to 15 plus into minus will become minus 4 plus 19 plus 14 plus 17 plus 16 divided by 6 is equal to. Similarly, average market returns. Average market returns is equal to 16 minus 7 plus 17 plus 17 plus 14 plus 18 divided by 6. Then RM is equal to, then average risk-free rate. Average risk-free rate of return, 5 plus 4 plus 6, 5 plus 4 plus 6 plus 6, 6 plus 5 plus 6 plus 6 divided by 6. So RM